Welcome to RBC's Markets in Motion podcast, recorded February 23rd, 2026, from New York City, where we're just not used to this much snow. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. In our latest podcast, we tackle the question of what last week's tariff developments, SCOTUS striking down IEEPA tariffs and Trump announcing new Section 122 tariffs, mean for our U.S. equity market outlook. The big things you need to know: in the near to intermediate term, we see these developments as somewhere between having little impact and slightly positive. Longer term, they're not a game changer for our view on the U.S. equity market, which has been and remains constructive over the next 12 months. If you'd like to hear more, here's another 5 minutes, where we're going to run through the 4 things we've been thinking about in the near to intermediate term as tariffs move to a new phase, plus one longer term thing we're watching. First, both the SCOTUS decision and the idea that the White House would implement tariffs through other mechanisms were widely anticipated by U.S. equity investors ahead of last week. We saw this very clearly over the last few months through betting market data, where expectations that SCOTUS would uphold the tariffs had been fluctuating around 30% since oral arguments in early November, as well as our own conversations with equity investors on the year-ahead outlook. It was clear to us from our conversations that the general contours of last week's developments were being baked in. Second, while it's true that uncertainty is elevated in the near term, in recent months, U.S. public companies have been emphasizing their ability to manage through the evolving tariff landscape despite persistent uncertainty. We've kept a close eye on tariff commentary and our transcript reading during the past few reporting seasons. S&P 500 companies have focused on mitigation efforts, including pricing and supply chain adjustments, and importantly, have also continued to acknowledge the dynamic tariff landscape. This remained unchanged in the latest reporting season. We haven't read anything indicating companies are not in a place to keep managing through. That being said, we didn't see much commentary specifically on what would happen if IEEPA was overturned from S&P 500 companies. When we expanded our search to Russell 3000 and S&P 1500 companies, we did find some comments from SMID names. Those include one company's comment on a tariff unwind being a pass-through event that might not benefit the company in the end, as well as other comments on how the IEEPA tariffs were only a piece of their tariff puzzle, as well as the general need and desire for certainty. Third, as the details settle, we will be keeping a close eye on company commentary to gauge potential short-term earnings impacts, potentially on the positive side. As our FX team has highlighted, the Yale Budget Lab estimates that before IEEPA tariffs were struck down, consumers faced an overall average effective tariff rate of 16%. Immediately post the IEEPA ruling, the rate fell to 9.1. After the Section 122 tariffs were imposed, they estimate the rate rose to the level of 13.7%. Our FX team has also pointed out that China is expected to see some of the biggest benefit from the new rules in terms of tariff levels, a thought that was echoed by an article in the Financial Times over the weekend as well. This jumps out to me because early on in the tariff discussion, thinking all the way back to late 2024 and early 2025, companies focused on impacts from China in their tariff discussions. And while some of that has likely been mitigated away, it's been a big enough issue it's worth keeping an eye on. And fourth, at the margin, we think the U.S. equity market could also benefit from a narrative shift near term, as attention perhaps moves away from AI jitters back to trade policy. There's not much to say here except that it's good for the market, in my opinion, to talk about something else for a while and move on to the next thing. And wrapping up with our longer term thought. One of the other things we're contemplating in regards to how this new phase of tariffs may reverberate in the U.S. equity market is its potential role in the midterm elections. We've been getting questions on the midterms from both non-U.S. and U.S. investors in our year-ahead outlook meetings and have highlighted it as a risk factor to our bullish view on the equity market due to the tendency of stocks to be weak in midterm election years and the tendency of the S&P 500 to trade in line with expectations for Republican election outcomes in recent years. Polling on approval on the economy and inflation have also been very low, and expectations for Republicans to take both chambers in the midterms have also fallen in betting markets. On Friday, our team took a look at recent polls published on the topic of tariffs specifically. Generally, the ones we found pointed to the idea that tariffs haven't been popular among voters, but that there is a strong partisan divide on the issue and that views on tariffs have been pretty stable since last year. The overall negative tilt makes us think it will be important to keep an open mind about whether the future tariff levels will be as high as they've been in the past, given the role that the affordability issue is likely to play in the midterms, as well as to what extent Congress can be counted on to provide legislative support to tariffs if needed. But the partisan split admittedly supports the consensus view that the tariff landscape won't change materially in the aftermath of the SCOTUS decision. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.